A father loses 40% of his retirement in 2008. He watches it happen on a screen, powerless. 6 months later, he opens a new account at the same bank. Nobody forced him, he just went back. Then he told his kids to do the same thing when they turned 18. That is the inheritance, not money, a habit of returning to the thing that hurts you. The kids did not protest. No signs, no hashtags, no speeches. They just quietly stopped opening the accounts their parents recommended. They moved money somewhere else, slowly, without announcing it. Banks noticed the outflow before they understood why. Executives who had never spoken to anyone under 30 started hiring 22-year-old consultants to explain their own customers back to them. Here is the number worth sitting with. Only 14% of Gen Z say they trust traditional banks a lot. Put 100 people my age in a room. 86 of them do not really trust their bank. The other 14 probably just have not been burned yet. That is not a small gap. That is a generation walking in already braced for disappointment. This is not irrational cynicism picked up from a meme. It is a calibrated response built from years of watching outcomes. A calibration is not a feeling. It is data processed over time, updated after every overdraft fee and every misleading pitch. Understand that distinction now, because everything that follows depends on it. If this is the kind of analysis that is actually useful to you, subscribe. I am going to keep walking through exactly how this broke piece by piece with real numbers, not vague complaints about greedy banks. Because the mechanism is precise, and once you see it, you cannot unsee it in every statement your bank has ever sent you. Here's the metaphor I want you to hold for this entire video. A conveyor belt. Long, slow, always moving. It carries your money from where you earned it to where somebody else keeps it. You step onto it the day you get your first paycheck. Remember this image, because we are coming back to it again and again. Along that belt sit a series of toll booths. The bank takes a cut through fees and through the spread between what it charges borrowers and what it pays you. The fund manager takes a cut through expense ratios. The advisor takes a cut through commissions. The credit bureau takes its cut simply by existing as a gatekeeper you cannot avoid. Here is the part people miss about the belt. It was never built to deliver you anywhere. It was built to move value through you. You are not the destination. You are the mechanism the value passes across on its way to somebody else's balance sheet. Once you see yourself as the mechanism instead of the customer, every fee starts to make a different kind of sense. If you were born in 1960 or 1970, the belt mostly worked. You rode it long enough, avoided catastrophic mistakes, and ended up somewhere decent. House, pension, some savings, slow but functional. Gen Z stepped onto a belt with the same paint job and completely different engineering underneath, and they noticed the difference faster than anyone expected. To understand why the engineering changed, you have to go back before Gen Z existed as consumers at all. You have to go back to 2008. Not because it is the whole story, but because it is where the crack in the belt first became visible to an entire generation of households at once. Picture a household in 2008. A kid, maybe 3, maybe 5 years old, watching a parent's savings account shrink on a laptop screen. The kid is not reading headlines. The kid is watching a parent lose a job, watching a house go underwater, watching the news explain that the same banks responsible for the collapse are getting rescued while the family gets nothing. Then, months later, that same parent walks back into a branch and opens a new account. That kid is not processing interest rate spreads. They are 6 years old, but they are absorbing something deeper than facts. They are learning at a level below language that money is precarious, that institutions are not reliable, and that nobody is coming to fix it for you. That lesson does not fade, it just waits for the kid to grow old enough to act on it. Fast forward 15 years, that kid is 20, working a part-time job, trying to figure out what to do with a few hundred saved dollars. A bank employee explains the savings account pays 0.3%, then tries to sell a credit card on top of it. And the kid, who watched the machine fail his own family and watched nobody get punished for it, simply says no. That is not defiance. That is pattern recognition. Here is where the clean story gets complicated. 2008 was not the disease. It was the moment the disease got loud enough for everyone to hear the machine grinding. The extraction had been happening quietly for decades before that, and smaller fees and smaller spreads nobody bothered to add up. 2008 just turned the volume up until it was impossible to ignore. Do this math with me, because nobody taught it in school. A 22-year-old puts $5,000 in a savings account paying 0.4% annually. Over 20 years, that becomes roughly $5,400. $400 of growth across 2 decades. Inflation during that stretch averaged around 3% a year, which means the actual purchasing power of that money shrank by roughly 40%. Meanwhile, the bank lent that same $5,000 out at rates between 7 and 25% depending on the loan. It generated something like $2,000 in interest income off your deposit. You received 400 of it. The bank kept the other 1,600. That is the conveyor belt working exactly as engineered. You stepped on, value moved, and the destination was never you. To make sense of who falls for this and who does not, I use a framework I call the 3 levels of financial awareness. It explains why people with similar incomes end up in radically different places 20 years later. It has nothing to do with intelligence and everything to do with which level someone operates at, mostly without realizing it. Level 1 is simple. You earn money, you spend it. You park the rest in whatever account a parent once recommended, and you never question any of it. This describes most people, not because they are careless, but because the system is engineered to make level 1 feel sufficient. Staying on the default belt requires 0 effort. Stepping off requires real work. Level 2 feels smarter but carries a hidden trap. You know about the 401k. You know the word diversification. You have a financial advisor. You believe the 30-year compound interest chart. The problem is the curriculum was written by the institution profiting from your decisions. Financial literacy taught by the seller is not neutral education. It is a sales funnel wearing a textbook's clothing. Level 3 asks a different question entirely. Who benefits from this specific recommendation? What does the real math look like across 10 years, not one? What happens to me specifically if this advice turns out to be wrong? Most previous generations topped out at level 2 and called it literacy. Gen Z, more than any generation before it, is being pushed straight into level 3. Here is the number that explains why. The top 10 financial influencers now reach more than 6 times the combined audience of the top 10 financial institutions worldwide. A kid making index fund videos from his apartment outreaches JP Morgan Chase's entire global social media presence. That is not a marketing footnote. That is a complete transfer of who controls financial information for an entire generation, and there is a number coming up that changes how you see everything I have described so far about wealth and trust colliding at the same moment. We will get to it. For now, understand this. Information democratization did not just add competition to banks. It removed their monopoly on explaining money to the people who needed the explanation most. You might assume more information automatically means better decisions. It does not. Some finfluencers are excellent. Others are selling a course on an arbitrage scheme that fails in any market you can actually afford. But even a noisy information environment that includes the truth beats a polished, curated one that quietly excludes it. Noise with signal still outperforms silence with none. If you are still here, you are exactly the kind of person this channel is built for. Most people clicked away minutes ago looking for something that felt comforting instead of something that was true. Stay with me, because the sharpest parts of this argument are still ahead, and they get more uncomfortable, not less. Now, here's a mistake almost every analysis of this topic makes. It frames Gen Z's bank distrust as a preference for better apps, as if young people just want everything on a phone because they grew up with phones. That explanation is comfortable for banks because the fix looks easy. Build a nicer app, but that framing misses the actual structural shift entirely. Gen Z does not conceptualize a bank as a relationship at all. Previous generations had a bank the way they had a doctor or a lawyer. You knew the branch manager. You called them when something went wrong. Gen Z wants a transaction instant and cheap and transparent, and they will leave the moment something better appears because there is no relationship left to preserve. Look at the switching numbers. 61% of Gen Z changed their primary bank within the past 2 years. Compare that to millennials, where only 28% switched over the same period. 61 versus 28 is not a mild preference gap. That is 2 fundamentally different relationships to the same institution playing out inside the same economy at the same time. Bank revenue depends on inertia. Acquire a customer young, keep them through the friction of switching, monetize them across decades through credit cards, car loans, mortgages, investment accounts. That model requires you to stay put. Gen Z does not stay put, and a belt only generates value if the riders keep moving forward on it instead of stepping off every 2 years to find a different one. Let me introduce someone. Call him Marcus, 20 years old, fictional, but built from a pattern I have watched repeat dozens of times. Marcus works logistics coordination, earning roughly $38,000 a year. His mother, a 22-year loyal customer at a large national bank, tells him to open his first account there. He trusts her judgment and does exactly that. 2 months in, Marcus gets hit with an overdraft fee of $35. He checked his balance that morning and it showed positive. A pending charge cleared before his direct deposit landed, and the timing broke against him by $4. $35 charged to cover a $4 shortfall caused by the bank's own delayed data. Marcus calls support, waits 22 minutes, gets a polite explanation that nothing can be reversed. The representative offers overdraft protection for $10 a month. Do the math. He pays $120 a year to insure against a problem the bank's own app created by displaying incorrect real-time data in the first place. 2 weeks later, Marcus opens an account at a fintech app that charges no overdraft fees. shows real balances instantly, and pays his direct deposit 2 days early. His paycheck starts routing there automatically within seconds of arriving. The original bank account still exists on paper, linked to his employer's payroll, but it has become nothing more than a pass-through pipe. The bank keeps the account number. It keeps none of the actual behavior. It cannot sell Marcus a mortgage conversation, cannot cross-sell an investment product, cannot build the multi-decade relationship its entire revenue model depends on, because Marcus does not think of it as his financial institution anymore. He thinks of it as a place his paycheck briefly touches before moving somewhere useful. Here is a small, almost comedic moment worth pausing on. A major bank launched a financial wellness chatbot for young users named something like Finn, spelled with 2 N's. Ask Finn how to start investing, and Finn recommends the bank's own managed fund, carrying an expense ratio around 1%. The same bank was simultaneously offering a savings product paying 0.6%. Finn never mentioned a low-cost index alternative. Run the numbers. The gap between a 1% expense ratio and a 0.03% index fund, compounded over 30 years on $50,000, comes out to roughly $42,000 lost. Finn was not built to help you. Finn was built to sell you, dressed up as a wellness tool, and users noticed immediately in the App Store reviews. Now zoom out to the biggest number in this entire story. Over the next 20 years, up to $124 trillion in assets will pass from baby boomers to their descendants. $124 trillion. That figure should make every bank executive lose sleep, because the entire architecture of traditional finance was engineered to capture a percentage of exactly that kind of wealth as it moves. Gen Z is not just a marginal customer segment banks can afford to ignore. Gen Z is the incoming owner of the largest wealth transfer in recorded history, arriving at that inheritance holding the lowest institutional trust of any living generation. The belt was built to process that wealth through mortgages, advisory fees, and fund management. Now the very people about to receive it are the ones most inclined to route around it entirely. This is already visible in the numbers. 35% of Gen Z investors hold more than half their entire portfolio in digital assets. Sit with that. Over a third of young investors have made a structural bet against the traditional system with actual money, not just sentiment. That is not a small experimental allocation. That is a generation voting with its balance sheet on where it believes value is actually headed. Now, you might be thinking every generation had it hard, that boomers dealt with inflation and stagflation. That struggle is not unique to anyone. And to be fair, that is partially true. Every generation has faced its own version of financial hardship, and it would be dishonest to pretend otherwise. But here is what is structurally different this time. Previous generations who distrusted banks in 1980 or 2008 had nowhere else to go. Gold under a mattress, cash in a drawer, impractical and limited. Today, there is a functioning global peer-to-peer financial infrastructure reachable from a phone. The distrust is not new. The functioning exit is what nobody had before. There is another trap waiting inside the traditional system, quieter than fees, and it is called the credit catch-22. You need a history of borrowing and repaying to prove you can be trusted with a mortgage or a decent loan rate. But you cannot build that history until you participate in a system you were already told not to trust. The system demands loyalty before it grants access. The result is what one study labeled digital ghosts. 35% of Gen Z lack any meaningful digital financial footprint. No credit cards, no loans, no leases, no home purchase history. Without that footprint, they struggle to access the very products that would have built it in the first place. A generation already skeptical of the system meets a system that demands proof of loyalty before it will even talk to them. But therefore this, some of them already left. 20-somethings sitting on 7-figure crypto portfolios are not waiting for a bank to earn their trust back. They are holding Portuguese golden visas, Dubai residence permits, coordinating deals over Signal instead of boardrooms. That is a small slice of the generation right now, but the question keeping bank executives up is not whether all of Gen Z bypasses the system. It is whether the system can survive losing even 10 or 15% of its wealthiest segment to complete exit. Here is the comedic version of denial. Picture the boardroom. Slide number 7, the retention plan. Gamification, a progress bar on the savings account. Confetti when you hit a milestone. A badge for 6 months of consistency. This is the pitch aimed at a generation that learned to code at 14, watched central banks print trillions and call it stimulus, watched an exchange collapse and regulators show up 18 months late. That generation is not rebuilding trust because of confetti. Though, to be fair, the confetti is nice. And here's the part almost nobody says out loud. Distrust by itself builds nothing, it just clears the ground. If a generation walks away from a broken system without building a functioning replacement, what is left is not freedom. It is exposure. Rejecting a bad deal feels like a win in the moment, But a win only counts if what replaces it actually holds up under pressure. We have not tested that yet. Not fully, not through a real crisis. You think walking away from the old system automatically means building a better one. Actually, no. Just over a third of Gen Z say they can save a little each month. 22% say they cover expenses but save nothing. Roughly 1 in 4 fall short every month. Less than 1 in 5 are saving for retirement at all. This is not a generation that cracked the code and left the old system in the dust. This is a generation mid-transition, and mid-transition is exactly where people get hurt. Therefore, the new infrastructure has its own cracks. 39% of Gen Z will delete a banking app after a single security incident, compared to 21% of millennials. One breach, one bad headline, and the relationship is over. 26% of Gen Z users who hit a data breach in a fintech app reverted back to traditional banking tools, at least temporarily. The apps are faster, the apps are cheaper, but loyalty in this generation runs in both directions and it can evaporate in a single afternoon. But we already got a preview of what happens when the new infrastructure meets a real crisis. 2023 Silicon Valley Bank. Depositors panicked, money moved overnight, and the failure spread through the tech and startup ecosystem faster than regulators expected. The FDIC stepped in. The system held, but it was close, and it was a reminder that neither the old belt nor the new rails have been fully stress tested through an actual sustained financial storm. Fast is not the same as proven. So here is the position I actually hold, and it is less dramatic than either side wants. Treat the entire financial landscape as a menu, not a religion. Use the traditional bank for what it is genuinely built for. FDIC insurance, established credit relationships, specific regulatory protection. Use fintech for speed, low fees, and automation. Use crypto and alternative assets for diversification away from fiat risk and access to asymmetric upside. Do not let any single one of them become your entire identity. Concrete version. Call her Priya, 23 years old, working tech support, earning around $52,000 a year with $8,000 saved. The traditional path, leave it in a savings account, paying 0.4%. Hope the employer 401k match does the work. Here is what Priya actually did instead. She kept $2,000 in checking for bills. She moved $4,000 into a high-yield savings account, paying around 4.5%. Then she opened a Roth IRA and bought a broad market index fund with an expense ratio of 0.03%. Therefore, run the math forward. That index fund charges her about $3 a year on $10,000 instead of $80 at a typical 1% expense ratio. Small gap in year one, compounded over 30 years on a fully grown retirement account. That gap becomes somewhere between $80,000 and $150,000. Not because Priya is a genius, because she picked a different toll booth on the same conveyor belt at age 23 and let 3 decades of compounding do the rest. You think her skepticism was just anxiety getting in the way of normal financial behavior? Actually, the opposite. Her distrust was the mechanism that worked in her favor. She found this on YouTube, not from a bank, because the institution she was skeptical of genuinely was not offering her the best available product. Distrust is not automatically good. It is a tool. In her specific case, applied precisely, aimed at a system that really was underperforming, it made her measurably richer. So here is rule 1, concrete and simple. Treat financial institutions as vendors, not partners. The entire marketing apparatus is built to make you feel like family. They call you a member. They send you a birthday email. They name their chatbot something friendly. None of that changes what the relationship actually is. Commercial, transactional, monitor the terms, switch when something better shows up. Feel loyalty to your own goals, never to the account number. Rule 2, build your information architecture before your financial architecture. Most people do this backwards, opening accounts and building habits first, then learning years later whether any of it made sense. Reverse the order. Spend 60 days learning before moving serious money. Learn the difference between a fiduciary and a broker. Learn what an expense ratio actually costs you at scale. 40 hours of deliberate study, and those 40 hours pay back more than almost anything else you could do with that time. And the final rule, the one that ties all of it together, distrust specifically, not generally. Blanket rejection of every institution costs you the things that are actually good deals. FDIC insurance, Roth IRA tax treatment, a credit history built cheaply and early. The people who end up wealthy are not the ones who trusted blindly, and they are not the ones who rejected everything on principle either. They picked through the machine piece by piece. The conveyor belt is still running. The only question left is whether you are standing on it or you finally figured out where it goes. If you want more breakdowns like this, subscribe. I do this every week.